Hi guys. So, if you were here yesterday, I'm Samir Shah. I wear two hats. I manage mortgage-backed securities portfolios, and I also have systematic uh, strategies that generate alpha in public assets. So the alpha business called Alpha Research and Management and MBS Market. So on the mortgage side, I've been doing mortgage credit since the 1980s. I did the first mortgage study of defaults in 1988. I beat Moody's to that study by about 2 years. So Morgan Stanley, we had a head start about understanding where losses would go and so on. And we've got a great panelist here. I want to show a few slides to create, some of these are the same as yesterday's, to create a framework for how to think about portfolio construction in credit. To me, it all starts with actually deciding what your risk profile is and how to manage risk, and then you select the assets. Most people tend to do the opposite, which is say, oh, something has nice yield, let me go buy it. I personally think that's the wrong way to do things. So let's see if I can get this going. Slideshow. Okay, so this was not shown yesterday. This is public asset classes, treasuries, the ag index, corporate high yield, mortgage-backed securities, and the dotted line, which is on the right axis, is the yield of the 10-year treasury. So you can see that rates have gone up, and they are still choppy around the 4% area. But what is interesting from the credit perspective is the green line, which is the duration of high yield. You can see that duration of high yield has actually been shrinking. IG corporate duration has gone up significantly. Treasuries and the ag, which is incorporates mostly investment grade stuff like corporate bonds, duration has gone up over the past few years. And so duration equals risk, right? So what's going on with high yield, I think, is two things. One is the market of high yield has declined by 25% in the past 4 years. And this is, I think, being cannibalized by private credit, which has been growing. So the duration is shrinking for two reasons. One is rates up, so duration will go down because of these high coupons. But secondly, the high yield sector is left with legacy paper. All the marginal guys that need to refinance are going into private credit. So I think private credit there's a selection bias here, where the high yield market is actually retaining better names of credit, and the sketchier guys are going into the private market and generating longer duration. So I think we'll discuss the private credit market over here, and we have some skeptics on the panel, so that'll be fun. This graph you saw yesterday, which is fixed income risk, has never been higher. So we know rates went up, and they're choppy. But if you look at the standard deviation of the returns, this chart goes back to 84. There's not a single portfolio manager alive today that has any experience building portfolios in this kind of risk environment. So as an emerging manager, this is great. The large guys have no advantage over or anyone else. So as investors, you should not be, I guess, drawn to the larger manager. I don't think they know what it is. And we can see that in the next two charts. This is the total return of the ag. Because volatility is picked up, all the large guys on TV saying high yield, buy out hedge funds, buy out ETFs. They're creating more and more fixed income active products. And money is flowing into this stuff. The ag has collected over 500 billion. And there's almost 1 trillion new fixed income funds that have come about that are all quote unquote active. this shows that the 3-year returns of fixed income have been negative. And this is two large firms, PIMCO and BlackRock's returns over the past 25 years, that are again against the returns of the ag. So one of the things I talk about a lot is behavioral biases in fixed income. And you can see this between PIMCO and BlackRock. The CIO of PIMCO is dynamics. He's a mortgage guy. He was my client when I was in sales and trading. So PIMCO funds tend to have a mortgage-backed securities overweight. Rick Reeder is a corporate guy, and he is at BlackRock. So BlackRock funds tend to be overweight in corporate credit. So when volatility was low, you can see that the green and blue lines are different kind of returns. They're both meant to be active, but whatever. I don't think that either is very good. But now vol has picked up. They have converged to passive. So all their expertise in credit means squat when volatility picks up. The reason for that is the traditional portfolio construction that the entire industry uses. So this goes back to belief in the random walk hypothesis, which is from 1860, which then led Graham Dodd to say, it's random anyway, so let's do security selection, build a portfolio, and manage risk through diversification. So all of fixed income does this. Equities has moved on with factors, but at the end of the day, every wealth manager is doing Graham Dodd. And the result of Graham Dodd is a convergence to passive. So now we see Vanguard reducing fees. At the same time, they're issuing active funds. This is like contradictory. Reducing fees is what you should do with all these active funds because they don't deliver. So I don't mean to pitch this, but these are two of my systematic stuff. I don't use Graham Dodd, I use Markowitz, which is what Diego also uses from yesterday's introduction panel. And if you use Markowitz, which is risk targeting, as opposed to yield targeting to build portfolios, you can generate alpha, you can outperform and do all kinds of beautiful things. This is the other important thing that people are not aware of. So again, part of the belief in Graham Dodd is diversification, which has led the entire industry to do these things called risk parity or 60-40 portfolios. And the belief is that fixed income will hedge your equity portfolio. And by diversifying into multiple asset classes, you will get benefits of diversification and risk mitigation. So this is the beta of equity, the S&P 500, to the ag index. And prior to 2020, it was negative, a little bit, volatile, but still slightly negative. So some scant justification for 60-40 portfolio. Today, the beta is +2. Equities have become fixed income. Not just fixed income, they become levered fixed income. So
you're running out of time, and you got to get to your.
Yeah. So anyway, that's the framework. So we've got panelists.
Can you take down your shares so people can
Yeah.
see the panelists?
Absolutely. Thanks, Marty. So our panelists have all different backgrounds, but expertise in different aspects of the credit markets. So I'll let them introduce themselves and describe how they got into this expertise. But we have Joe, Suzanne, Maxwell, and Tom.
Hi, I'm Joe Goschalk. Yes, native London, now of New Jersey. By background, I was restructuring guy in the UK. What's called an insolvency practitioner. So credit distress was always in my blood. I been working with the family office for the last 10 years in London. And doing credit investments, not generally in terms of the sort of more public credit, unless it was there are interesting distressed situations would come up, but mostly privately targeting credit opportunities, what you might call private credit, but direct investments into corporations and opportunities where it's hard. I mean, essentially why private credit, the banking, the entire sector's really changed. There's mid-market banks don't exist. in the way that they did. You can't just go to a high street bank and get a loan like you were able to. And the ability to just sort of fill that hole as a family office investor into opportunities that we saw and see has been quite interesting and quite productive. So that's primarily how I look at private credit in terms of my things. So, yeah.
Hi, I'm Suzanne Murphy. Some of you guys saw me this morning, so I won't bore you, but I wear a couple of different hats. I have been in the credit space for a long time. I do have a family office called SEM Investments. We invest primarily through funds. We do not do traditional fixed income. I totally agree with your comments on you can't go into a high street bank anymore and get a loan, particularly if you're a small company. My day job is I'm a managing director at a family office that's trying to relaunch a fund called Lampe Conway. We're in the lower middle market restructuring space. We think there's going to be a lot of opportunity. I do think that there are systemic problems within private credit because there has been poor underwriting over a period of time. But I do think this vintage will be very interesting because there are these small companies that are what we call the have-nots. The other space I potentially think, well, I think not potentially is very interesting is real estate lending, particularly if you're coming from a place of a clean balance sheet.
Great segue. So my business is Fulcrum Lending. I started off in the distressed credit space, ultimately realized you can't be chasing 20% returns every day because you live in a state of distress. Really, if you want to build a scalable investment manager, it's about creating a large capital base. And so the asset class we focus on is multifamily, only multifamily. That's the only real estate asset class that we focus on. We do high yield loans, and how we capitalize it is through an A-B structure. We keep the B, which is a high yield subordinate piece. We sell away the A to our separately managed accounts and really banks. So we have discretionary capital of about 500 million to go deploy across this strategy. It's a very niche strategy, but to the other panelists' points, it comes down to underwriting and a really strict, underwriting process, which we have a technology platform that codifies that and implements it at scale.
My name is Tom Gere. I'm with the
Tom, your mic
company
might
called
be-
Brean Capital. Beg pardon?
Check if your mic's light on.
I think we're good
All right.
there. So we are a broker dealer in New York. My space in the fixed income department of the group is in whole loans. Marty's tried to get me on 3 different panels here. We talked a little bit about commercial real estate that I didn't join yesterday for an analogy that I'll have in a few minutes. And then you had me as a visual aid for Joe Narita's presentation a few minutes ago, so I appreciate that. And at the end of the day, we broker whole loans as opposed to, in my group, sell securitizations. So there are different ways to bring in mortgage and installment loan products to the marketplace and liquefy them and create yields for investors. And the whole loan market is slightly higher than the securitization market in terms of yield expectations. Part of it is it's not watered down with legal fees. It's not watered down with analyst costs. And you do have an opportunity to speak directly with the seller. And so if those little voices are going off in the back of your head, is this a good investment? Is this the right investment? Or is this a fugu, which is a poisonous fish? It's really not something that you're leaving entirely to the quote experts in the field, because the experts can be wrong too. As an analogy, I was at a conference in Chicago in 2010, and it was a distressed commercial forum, and the speaker after lunch starts his conversation with, I ran the commercial securitization department at X Brothers, and my name is Henry, and I did some really bad things. Well, that woke up everybody that just came in from lunch, right? So all of a sudden, people are sitting up in their chairs, and he goes into, some detail as to how over successive securitizations, they started leaving things out. And so it's not always what's disclosed in a securitization, but it's also what isn't disclosed. And to Peter's point earlier, diligence is a meaningful component of your investment strategy. And you got to think about ways that it's presented. You got to think about the ways that perhaps it's hyped, and you got to think about who wins in that situation. And so the whole loan side offers a little different perspective. It allows you to get a little more yield because you don't have the heavy expense load. In addition to that, you have an opportunity to do your own diligence and speak directly with the officers of the firm. And if those little Thomas Magnum voices start going off, this is not a good thing. You'll feel it, or you'll double down. And so we do bulk trades, we do forward flow trades, we set up investors with a series of options to put their money to work over a period of time. So I'm happy to speak with anybody in the family office space that sees something that isn't a fund and isn't accusive that they would like to pursue. But in some ways, I feel very small compared to these technological unicorn opportunities where our yields are generally presented at a spread over SoFi. And sometimes there's a credit enhancement and sometimes there isn't, but it generally runs from 6 to 36%. And so if those are sort of the fixed income yields that you feel in a particular bucket you're comfortable with, we have offerings in the consumer space, the mortgage space, and the commercial space that we're very, very active with in our group.
What's the liquidity?
Pardon me?
Liquidity.
Oh, in terms of scale deals and size deals, they can be $3 million or they could be $3 billion. So
I'm asking for how.
Okay.
what's the
Duration.
These can be 2-year assets. These can be 5-year assets. These can be 10-year assets. I have $200 million worth of franchise loans, for example, that are 10-year term, but they have a 3-year life. And they have, traded typically around 250 over SoFi. They have very small loss potential to them. Their loss history has been 29 basis points a year for 3 years. So you're getting in the 8s. Some of the installment loans that we're selling are 1.5-year type products because of their burn rate on them. And those two would be in the 8s and 9s. And then we go up to scale prime, near prime, subprime. So to get you an unlevered return of 10, 12, 15% is sort of commonplace. On a levered basis, you can get into the 20s. Thank you, Marty.
Another question from the audience?
Sir,
What's your principal loss experience?
They generally 3 years, 4 years, 5 years, sort of depends if you're in the pool loan lending business or pool loan investment business. It can be a 5-year asset. So,
Tom, the question is, what's the loss experience?
Yeah. Oh, loss experience. Okay.
Yes.
So, it sort of depends. The 29 basis points a year for those franchise loans is very good. It's a very seasoned company. The woman that's running it is an ex-semiconductor executive. So she's very, very sharp. In the consumer business, the short-term duration stuff has generally been 4 and 5. So, you're generally buying a note at a 13% rate, expecting 5% losses, servicing for 100 basis points, and the net would be your expectation in yield. It could be 15% if you go to the next tier credit, and the same thing. Losses get a little wider, servicing gets a little higher, but your yield is also net to you going to be a little higher in the high single digits, low double digits.
What is the underlying protection? Is it the loan to value? Do you get personal guarantees from the?
There are no personal guarantees on consumer loans, but some of them do have safety insurance wrapping on them. So you could have up to a 14% loss and still be protected and still get an 8% return.
What kind of LTVs are underlying that?
Well, they wouldn't have an LTV because they would be unsecured. On the mortgage side, maximum LTV, we have wealth investor loans that are in the 7s that have about a 4 basis point loss. And so those are 100% jumbo loans, 100% yield. They're made to doctors in particular. So you have, a variety of different things if you want to think scale in the mortgage side and think security with secured collateral versus unsecured collateral.
Maxwell, sorry, any more questions?
Another question?
Yeah, what size are you talking about?
We'll do deals. I mean, we represent credit unions who don't do huge deals, as you might expect. But on the personal family office side, we could do as little as $3 million, and we can do as large as $1 billion.
And how many loans do you get for that?
Well, it sort of depends on the average loan size, right? So if you're doing a $1 billion deal with SoFi, they're going to be $10,000 loans. If you're going to do, retail or indirect auto loans are gonna be $29,000 loans. So it sort of depends on which vertical you really favor. Mortgage loans would be 150 or 180 or 700,000, sir.
How can you hedge against interest rate fluctuations?
We have hedging strategies that we can share, which, would generally be, IO strips, and make those sort of, compelling arguments for the duration. And some you wouldn't want to hedge because the cost of the hedge is going to take up too much of your return. And you sort of hope for the best, but you look at the previous performance of that product by that manufacturer or loan originator and sort of, level your bets, which is the exact same thing the analysts would do at DBRS or Moody's or S&P. So, but you'll be doing it yourself with some history as you, and benefit also is in many of these cases, you have the benefit of securitizations that show the actual performance updates every year. And so you can use that knowledge and factual information to put it into your model.
The hedge, did you have, Zach?
Say that again?
Old swap?
Yes,
You
yes,
would have a liquidity mismatch, Steve. I'll be careful.
exactly.
CDS.
That's what I'm asking.
Yeah.
But not on the
You're better off
non-prime.
not
You
hedging.
you wouldn't have a mismatch on the non-prime, but you would have a mismatch on prime. So it sort of depends on what your yield targets are.
Maxwell, how about losses on multifamilies? What's the cycle there?
The best gauge you can really look up, it's all public, is, you look at Freddie Mac, Fannie Mae, government guaranteed loans, just multifamily. That's really what I care about, losses. And there's even realized losses, right? So commercial real estate broadly, conduit, single digits, stressed it, high single digits. Multifamily has always been inside of down to 60, 80 basis points, maybe running up to like 4. So we focus on multifamily for a reason, precisely for that.
Thanks. Suzanne, you've certainly invested in this stuff over time, many times. Are you involved in the space right now? What do you like? What don't you like?
So I have, and as I mentioned, I really do like commercial real estate right now. I would say not office, multifamily, conversion, particularly in bulge bracket markets, right? High quality assets in Miami, New York, not in Peoria. Oh, you did? Sorry. I'm just saying bulge bracket markets where I think there's a lot of opportunity. I do think that there is going to be opportunity in secondary private credit that needs to get worked out. But again, it's who is the underwriter? How are you underwriting that yourself? Again, we generally invest with managers that we trust to do that. So I hope in our due diligence job, we're doing our proper due diligence on the people that are doing the management of the assets. And, I think diversification is key. And diversification means I had a mentor in the investment business who used to tell me diversification is only meaningful if it's meaningful diversification. So you can have a lot of assets in places that look different, but actually when the correlations go to 1, you can be screwed. So I think it's really understanding what the underlying assets are. And I think the last thing I would add is, as credit people, I don't know how the rest of you feel. And having started, I'm going to date myself, having started my career at Drexel Burnham, who said that?
Are you guys aware that Mike Milken invented the CDO? He has this absolute stroke of genius that a diversified pool of high yield credit could only certain portion of it defaulted. So,
but the thing that I was going to add is that as credit people, we are glass half empty people.
yes,
Because the best you can get is par. The worst you can get is 0, right? When you're an equity person, sky's the limit, right? You can, some of these interesting private equity deals we heard about today can be 10 backers, 12 backers. When you're investing in credit, you're not getting that. So you have to come in.
But unlike everything else that we hear about, and it's all great and it's 10 baggers, and there's nothing like a slide that says 185% IRR star unrealized. Great, thanks. Thank you for my lovely unrealized gain that I now have. The game with credit, unless you're playing distressed, which is a bit different, to be fair. Credit from your family office perspective is income. And that's the bit. And so, as Marty said, and I really need to get where he got his reference from on your inflation for family offices. The well-known, so thank you, well-known internet fact. So it's high, and you want income, and you're playing this game as a family office. You need the income because you need to sustain lifestyle. You still need to buy your bloody groceries, and you don't want the asset degradation. And you don't want the capital degradation through inflation, which is just the nasty little tax that sits there and plays with credit markets. And that's the bit where credit is part of your family office approach, which isn't necessarily the 60-40. The 60-40 is a protection thing. But if you think about it from a family perspective, we're thinking about it in terms of the income, certainly as far as US equities go, getting dividends is extremely hard. Decent dividend growth is extremely hard still.
I'll give you one example of how bad inflation is. If you buy a yacht, let's say that you have a house in California and a house in Florida, and you buy a yacht and it's stable in Florida, but you bring it to California, one day in the first 3 years that it's owned, you get charged a sales tax by the state of California. Right? Same thing with planes.
Yeah.
So you can have it somewhere else, but you cannot take it to California.
I have to admit, I have never visited California, and I'm now not going to do so in my private jet. Thank you for that in advance.
The one thing I also wanted to add that people don't think about, I was on a panel recently at a different conference, and it was me and a bunch of real estate guys, right? And they were talking about their net returns to investors. And I said, wait a second. Are we talking about levered returns or unlevered returns? Because one of the things that people miss in credit often is the leverage component or back levered returns, to your point. But
So
you really need to understand what a 7% yield is versus a 14% yield versus a 3% yield. They can mean totally different things. And I think people forget about that sometimes.
It's the return on equity versus the return on assets. And
Right.
half the time when you talk to family offices that are amateur investors that jump into multifamily, they don't know the difference very often when, it's the 20-year-old guy that's giving away the money.
What's the old
My
saying?
daughter's
You can't-
money's
you
in
can't
trust
do
till
IRR.
she's 40. And if she doesn't have a prenup, she never gets it.
But again, I'm sure you've educated her about the difference. between
She's
now
12.
and- It's never too
What
early
about
to
your
start.
grandkids?
I'm sure you've educated her.
We're working on it.
So have any of you guys looked at hotels, by the way? Because this is the most volatile commercial asset class, hotels. And so there's a time to buy the dip every once in a while.
Hotels is an asset class.
I'm talking
Interesting.
about hotel
So that
There's a-
it's a lot of it's like where your market is what's the what does the market look like? It's very location specific, and you also, the thing with hotels is you fall foul of the redevelopment cycle, and you kind of need to be reasonably aware of that. So the classic we used to see was the hotel would default. It's back when I was in practice. The hotel would default and get sold. They would literally, they would just rotate because you did the refurb, you ran out of the cycle went against you, you ran out of money, you defaulted. The bank took it back at the right point. Again, this was my practice. The bank would take it back, And then the new buyer would come in and you'd pick up this really lovely, just redone hotel that had defaulted. So where you sat in the debt cycle was just, where you sat in the redevelopment cycle was kind of crucial as to whether or not you were going to default on this debt. But yeah, it's highly market dependent.
It's a very cyclical business. I think right now, and even though you're not in that business, I'd love your opinion. I think the market for trophy assets that need to be refurbed, there's a huge opportunity in lending to those assets, but it's like the Amman Resort in Jackson Hole, right? But it's trophy properties in trophy markets,
So that's a great
like
example.
Naples,
Yeah.
Miami, like.
I was just there in Jackson Hole at the Amman, and they were just going to close it down for big CapEx. And there's.
I know the person who's doing the loan.
Okay. So, I mean, to your point, it's very cyclical. That is real estate. But as far as you look at those asset classes, you got to look at the shape of the leases, right? So these are daily rates versus multifamily, which are annual, corporate, which are longer term. Same thing with retail. When you're looking at the cycle, and everyone has to kind of make their own minds up where we are, but I certainly don't think we're in a recovery period. And hotels are where you put your money during recovery because you have the most mark-to-market opportunity. So if you think there's going to be a big upswing soon, sure, put your money there. That's not the camp we're in.
I mean, I would totally agree with you on office, with the exception of very specific properties. But I do think with trophy hotels, rich people are still spending money.
Yeah, I'll say, yeah, trophy hotels, trophy assets broadly, those are really the exception to the whole. Because the thing is, right, and this kind of goes.
I'm not saying lend to Motel 6.
No, definitely not. Definitely. I mean, we've had hotel conversions come to us.
So,
I will
Okay.
Marty, before you go, just so you know, the banks don't agree with that. The banks, and you said yourself, the guy who's lending on it. It's the guy. It's you guys. The banks, if they can shove it into an SBA program and get paid 114 for it, have 75% of it sold, 25% exposure, they're doing it. They're not keeping it in portfolio. It's two reasons. One, there's an oversupply, and two, a concentration risk by putting those on the portfolio because they got enough. And also, there's other stuff going on. There's 41 migrant hotels in Massachusetts. God only knows what those are going to look like when the rules change, the people leave, and what sort of upgrades need to be done. So it's still, in my opinion, from a lender's perspective, an opportunity for you guys. Marty, go ahead. Sorry.
Yeah, so my question was about secondaries. I mean, our group got into secondaries in a big way in 2009, 2010, right? So are there just so many secondary funds out there now that everything is like a slow rolling disaster, right? I mean, it's like the Titanic at, very slow speed, So
I
maybe
think-
about and also my question about, assumption of debt, right? Because there were so many great deals done in 2010 where, guys came in and they just assumed all the debt and then bought like, what was that place in Union Square? One of the big hotels in Union Square, they bought like.
The W maybe?
The W.
The W.
I bought for like $5 million and the assumption of debt, right? I mean, maybe you guys talk about that, like impairment on debt, et cetera.
I mean, I think, where we are is in a weird place where things aren't breaking yet. And, right, that's when you really are going to have a time to buy and have a discount to par. That's the whole play. But you can wait forever for that. That's the thing. And I go back to what I said earlier, right? I started off my career in distressed debt, distressed credit, control for equity, right? And you have to wait a really long time. Like if you're a family office or you're a money manager, your job is to put money out and earn a return. Dead money doesn't do anything. So as far as we look at it, right, it's the principal protection, but how do you consistently print, low teens returns, 10, 12% continually, right? There's short-term, high yield, short-term debt. That's interesting. But then you're getting a new asset behind that credit and you have to get comfortable with it, understand it, right? Whereas if you go longer duration, that's a really interesting story. And then when you have a market again, reason why we select multifamily is because it's 1.5 trillion. Right? Of all the other asset classes within real estate, that's 50% of all of it. All the other asset classes comprise 1.5 trillion as well. Right? So when we're thinking about the deepness of the market and how consistently you can put money out at a consistent rate of return and a investing blueprint that's very replicable, that's interesting.
And the other difficulty with hotels is their functional obsolescence versus multifamily, where that cash flow is going to be something that you can put minimal investments. Whereas the functional obsolescence of some of these hotels, they go out of style. That's an issue. Or they have other geopolitical issues. How many people here know that the Luxor and Excalibur are sinking in Las Vegas? They're coming down. So, there's just things that can happen with hotels that don't seem to happen in multifamily space.
I think the issue, I think more a point to come back to is in terms of the lending market at the moment, and to your point on secondaries, is the oversupply of credit in the market. I think that's probably a key point. Like every conference I've been to on various topics has always had something on private credit. And even on the most,
I was
had
at
nothing to do with something completely unrelated to it. And
No.
it'll have something on private.
I was at a conference earlier this year and somebody, I don't even remember which booth, they had mints that said private credit. And I thought, this is not a good sign.
So the private credit market reminds me of 2005 right now, where you've got all kinds of pensions filing, giving infinite amounts of capital to these large managers. In 2005, it was banks, because of Basel II, giving managers money to buy AAA floaters. Same thing is happening right now in private credit, where you've got a ton of dry powder because of pension plans just trying to do anything to get some yield, right? Because their fixed income is not working. And the net result is people are creating private credit with all kinds of sketchy stuff to feed the demand that Apollo and Blackstone, all these guys have for the stuff. And the worst version of this, in my view, a year ago was Brean, and now we have the State Street Apollo ETF.
Well, but it goes back to due diligence, right? And I think that there is, look, Basel Endgame is coming.
Sorry?
Basel Endgame is coming, right?
Yeah.
It's the credit markets are only going to get tighter. So private lenders are going to be more in demand. That's to your point, the pension funds have to put the money out, but it's who they're putting it with.
And the insurance companies who have different.
And the insurance companies.
Insurance companies have different issues because they're dead in the water on CRE. They can't bring their yields up and they can't hit that 5-year balloon because they don't have a borrower who can pay them off.
And to that point, you then have a venture side, which is, and again, you then come back to the equity company investment, so I call it company investment side, which isn't giving dividends, which is where you kind of want to be in a positive interest rate environment where we are now. I want to see, why can't I get decent yield out of McDonald's shares? Like, that is a problem.
There's a question, but I just want to add one thing about insurance companies that people forget, right? They want to do co-invests. They'll invest in a fund to get access to the co-invest because insurance companies get huge haircuts on their balance sheet for investing in funds.
Well, they're not investing in funds anymore.
And they don't, well, but they don't have the staffs to be able to do the work.
Right. I mean, I guess I'll caveat that how we structure it for insurance companies to really take delivery of it. So they have these categories, CM1.
SMAs.
Yeah, well, SMAs, but you have rating categories of CM1, CM2, right? Equity funds fall in like, I think CM3 plus, like kind of like MES. But you have really severe capital treatments there. But really the point being, similar to family offices, right? You have massive streams of cash flow coming in that you got to do something with. So that's what we refer to as really liability driven investing, and that they are true liabilities. When you make that much cash, that is a liability. And if you don't put it to work safely and responsibly and do the work, do the diligence, right? You're going to be losing money.
There was a question out here.
Yeah, I'm curious if credit insurance has resurged. I mean, it was pretty popular and then fell apart in 2008 with the financial crisis.
No, AIG went bust. That was all
It's
AIG.
resurging in the wrong areas.
It-
So you're seeing some Bermuda insurance pop up and you're seeing guys with very ambitious plans, but when you really peel back the onion on their financials, they may be protecting $1 billion worth of installment loans with a credit wrapper on it, but they only got $1 million worth of cash.
Yeah, because I heard those, what you just said, right, and I didn't know how prevalent that was.
So you're talking about all the reinsurers, right? The Bermuda, I mean,
It's back to leverage, right?
yeah, it's all back leverage. You get a better rating, right? I mean, yeah.
Exactly, until.
Sir,
Any other questions?
Where would you finance? Where would you finance? Any thoughts?
where would you finance?
No.
You're talking, yeah, you're just talking about.
Revenue finance as an asset class.
Oh.
I don't have it.
Again, leverage, leverage is a big play, right? I mean, you're gonna refinance it into it.
Finance a restaurant, you take money back on a daily basis from the revenue.
You're talking about factoring. So
Well, not,
Yeah.
it's
Yeah, there's
different,
a whole
different,
bunch of
it's different than
factoring
factoring, but
strategies.
it's cash flow finance, it's specialty financing, it's really ABL, right? But yeah, you're financing contracts, that's the asset base, and you're right, your discount rate's really the certainty of that contract and the cash flows associated with it. But yeah, Marty, to your point, it is a great business. It's a tough business to do. Yeah, it's very specialized, very niche, not that large, but.
It's not easily scalable.
I have one of our family offices saying that you guys are way off on credit. There's just three variations on the private side, and it's all depends on the niche.
I mean that's a fair statement. This is the problem with private credit, which is it's anything that's not lent by a bank. So yes, in fairness, it is a ridiculous name for something. It's enormous if pseudo banking transactions on big capital raises to tiny little things.
Any one of you give 3 examples outside of what you're doing right now that are highly niche private credit opportunities.
One of my old bosses is doing factoring. He's getting about 30% returns. But it's on a deal by deal basis. They send out an email saying, we have this opportunity. It's $2 million. It's $30 million. I think they funded Tyson's fight in Las Vegas. That was a $25 million check that paid off after 2 weeks. Stuff like this. But it's very niche. It's one by one. But
company right now that's paying back based on revenues. And then maybe 20% off the top. They pay back the 2-3x. Minutes for several $1 million.
Marty, we've
Was one of the great factoring companies, right? They factored revenue from
right,
gains on your cell phone.
right, and debt consolidation. There is that element of the consumer, the rich get richer and the poor keep getting poorer. We've got that spread. Question.
If I were looking at transactions and investing in debt situations, credit situations, I'd be looking for equity kickers. The spread would be the loan amount and the growth potential, and the spread on that growth potential, I get a piece of it.
The thing with equity kickers is
I'll tell you a company is doing it.
Yeah.
it's great, and if I'm looking at it from a corporate side, a lot of the smaller companies really love this because it's a great way of raising without having to deal with this.
Do it down.
Yeah, I mean, I'm literally trying to. We're basically I'm helping the company structure one at the moment, where there is a basically combined debt equity play. The problem is that lenders. This is where family offices come in. So this is where a family office can really deploy its special sauce, because you have the ability as family offices to go, I like this investment as an investment, and it might be debt, it might be equity, but I can do a structure that I really love. It's very hard. A lender, none of these private credit funds, Blackstone can't do that. They have a fund that has its mandate. It's got to lend, because otherwise they can't. The insurance companies. So we have assigned this money to lending. They cannot do equity kickers. So if it's a question of being nimble, that's family offices can be great. If you've got your act together, you can make a decision. We're done next week. Thank you very much.
You'll see a lot of that in the charge off. Yeah.
Those transactions like this.
Right.
They're funded by KKK.
That's right. KKR. Right,
KKR,
yeah.
I'm sorry.
So it's very popular. It's very popular very popular in charge offs, very possible in distress loans, very likely in near prime. And it's also a lot of mezzanine financing going on to grab that piece of equity out of warehouse. So, but it was very popular. When the credit card charge offs really hit 10 or 15 years ago, it's still around. But generally you're taking a risk and you're taking a piece of the equity and taking 50% of the proceeds on the end.
Yeah, the other side
Very,
you
very,
get it is dip lending.
yeah,
Well,
dip
dip
lending.
lending tends to be very equity debt. And again, it's quite specialized. So it's again, are you in that space? Do you want to, the guys in that space know what they're doing? If that's what you're into, speak to those guys. Like they are the experts, but speak to the guys who've been around through a cycle or two.
But I think there's an argument if a company is in a cash crunch and they have the choice of doing a down equity round or doing a convert with warrants, it's a better choice for me as an investor and it's a better choice for the company and the company's longer term success. I mean, it's always amazing to me as an investor how the private equity guys don't really understand the cap stack. And they don't care.
To my point, this is the problem. Lenders are lenders. VCs are VCs.
Focused on scale. They're not
But
looking
they
for-
also don't,
They're not
like-
looking for details.
they're happy to lever up the company, dividend it out to their own investors, and then whatever happens, happens.
And then there's the
That's just a tool, right?
Fintech.
That is it's a tool and it's an exchange of rights for cash flow, right? That's very simply what it is. Factoring, dip financing, high yield, whole loans, whatever you want to call it. It's about structuring your rights to cash flow ahead of someone else. But no matter what, you still have to figure out what the value is. And that's the thing that's kind of just been said repeatedly. And I would say the caution you have to take going into private credit with so many people rushing in is, does everyone have the right peg on value? And that's the thing, like fundamentally, there just isn't that. So you are going to see people make these kind of ridiculous loans at these ridiculous marks because they don't understand what that creation value is. For real estate, it's a little bit more simple. There's a cost to building the thing and replicating it. But as far as corporates go, right? How do you rebuild that business, right? That's intrinsic value, that's creation value. So, I mean, the people that are really going to do well in private credit are the ones that actually understand what creation value is. And then whatever you structure around that, that's just the agreement that you make between you and the borrower. Because sometimes they want you to have rights to the assets or cash flow financing, whatever it may be. But go ahead.
Yeah, so you were talking, how strong are the covenants in the private credit market?
I think it
But you make
depends.
it.
Yeah.
It's you make your own rules. Like, you made your own monopoly game.
And
So-
this is where the secondary market's going to be. Do your due diligence. Do your due diligence. Do your due diligence.
So,
There are managers in the private credit space that take way more risk than I would be comfortable with. So they might be lending at, I'm making these numbers up, right? 30% LTV. Like I want to see 60% LTV with all sorts of covenants and being able to take back the asset if that needs to happen. But there are people to get these yields that are not doing that work.
so I would segregate that based on the incentives of the manager. So the larger guys are, I think, have so much pension capital that there's a food fight for assets. And they are fighting for assets by weakening covenants. The smaller individual people with their own money, the family offices that are sharing investments like these guys, they are much more careful. It's their own money at risk. They're not in it for the carry and the management fee. And so you got to look at the incentives and and that almost perfectly correlates with the covenants that they buy.
You gotta look at very carefully when you're talking about covenants. you gotta look
Steve, can you speak up? Okay, can we borrow Mike? Thank you.
When you're talking about covenants, you gotta be very careful because there's downside to them. And if you don't have the flexibility to address those covenants, they could kill you. So you really have to know what you're doing when you get into covenants, ratios, et cetera. Because if you plan it, I've structured over $1 billion in transactions. Let me tell you, if you don't know that component, you're dead.
I think that's.
We've got a fair number of guys in the small fintech space that insist on having an operating role with the company as they put their money in. Fine, I'll come on board, I'll put $3 million in, but I want to be chief revenue officer, right? So they want to participate, they want to use their expertise and connections to backstop their investment. And on the big side, just so you guys know, the supply of investable assets is really getting spoken for by the insurance companies, by the private equity firms. I mean, you see transactions, SoFi sold $2 billion. As the private equity firms all, sort of suck up an insurance company, a low-cost provider to pick up where the banks used to be, but aren't anymore. Then you have $1 billion and $2 billion transactions. SoFi, $2 billion in Nassau through Fortress, and another $500 million forward flow. Liberty Mutual bought $2 billion worth of firm paper, buy now, pay later. So that's non-prime. So the insurance companies are not only getting into the consumer space, which you people may want to be in, but they're also going up the scale on yield and taking more risk just to offset the commercial loan portfolio that isn't moving. So there's a lot of dynamics going on, and there's a lot of big money going out the door, and it's tougher for guys like us, who are on the whole and broker side, to find supply to make available for investors. So it's a fight.
Time for one more question. Or you can just wrap up and give a closing statement.
When we, I don't have, okay, I'll make a comment. Multifamilies. So over the past 5-7 years, when rates were very low, a lot of amateur multifamily investing got done with really bad capital structures. So multifamilies traded as a property are probably still around 40 cents of what they used to be because of a negative income flow to their capital structure. Basically, they took floating rate loans, and as rates rose, that wiped out their net income. So this is also true on the hotel side, the smaller hotel side, mom and pop stuff. And so if these properties can be had at great discounts and then restructured, recapitalized, I think there's opportunity for private debt in this space if you can access the properties and recreate the equity.
I think that's.
Yeah.
You're the best.
I mean, I'll tell you, I haven't seen anyone take a 60% markdown on a multifamily asset. And I'll tell you that those, really, let's call them what they are. They are syndicators. They are coming and they need money. They have a huge gap between where they can finance their properties today and where the outstanding debt is. So let's just say the last dollar on their existing cap structures at 85 cents, right? Today they can maybe get 65, 70 at best, right? But in terms of values, right, your loan is probably still going to get paid back at par. Even the lenders that made that loan back then, purely one, liquidity, but borrowers can put more money into it, but structured right, and if you have the right product, you can actually go refi those things out at par. We obviously want them to put that money back in because I think 15% down is not how you run a business. There will be opportunities, but you can't wait until you have a 60% haircut on the asset value. That there's way too much liquidity in the system for that to happen. You got to put money out today. And so we can put out, subordinate debt at low teens, 12, 13, 14%. That's what equity investors, value add investors get, maybe 15%. Their investors get 12% net. But we don't have to go renovate the property. We don't have to go do all that. We let the experts do that. But again, going back to this contractual agreement that you have with the borrower, you're extending credit and you want priority in the distribution. That's all it is, but you still have to have the right marks.
And since we haven't bridged this question, but as a last closing thought, from our family office perspective, we are in the higher for longer camp. Like, I don't think rates are coming down anytime soon. I think that's gonna make it harder for borrowers. And no politics, despite whether you like Donald Trump or don't like Donald Trump, he can't make interest rates come down. And I just think the dynamics of the market are, we are in a higher for longer environment.
And
And
more volatile.
well, but that's comes with the territory, right?
No, I think it's a lot.
We're running out of time.
The market has been trading.
Lightning question answered.
Okay.
All right,
Anyone else?
Joel, closing comment?
Yeah, I mean, it's just coming back to this thing. It's the two things that you have to think about as a family office. Inflation will kill you slowly. You have to get, and there is a need for income. There may or may not, but there's a need for income. That gap has to be bridged. Credit is one of the few ways in which you can reliably do it in this sort of environment we have today. But there is oversupply. There's a lot of people out there. A lot of people who don't necessarily understand the downsides, who haven't really dealt with the workout. And I think it was one of your guys, Andrew Chiff, on the previous panel I was on with him, said, what's their workout team like? What's their experience when things go wrong? And if they don't have good experience in dealing with things when they go wrong and workouts, do you really want to put your money with these guys?
Yep. Are we good? Great job, guys. Thanks so much.